Of late, Aegis Logistics has attracted special attention of the market for its massive growth plans. Aegis is a logistics service provider to oil, gas and chemicals. Its liquid division takes care of terminaling requirement of liquid chemical and oils. Gas division is centered around LPG from sourcing to distribution. It has got a network of auto gas stations where the clientele are varied, and its major income to the extent of 2/3 is coming from gas. Two unique features of shareholding pattern of Aegis. Foreign promoters, OCBs, hold 58%. Institutional investors, foreign, hold 16%. Total, almost 75% is held from abroad. I'm Vittal Prabhu, bringing you the weekly video on Stock Learning Simplified. Hope you will find the video quite effective and useful. Location, efficiency and customers. 3 points of success for Aegis. Storage facilities at various ports of the country, great locations. In liquid terminaling, full capacity utilization, and when it comes to LPG, select customers, especially national oil companies. Net worth of the company has grown healthily at a 5-year CAGR of 13%. Its debt has relatively remained less, 531 crores over 2045 crores, but EBIT has failed to keep pace with the funds deployed, and therefore the ROCE is relatively low at 15%, falling from a high of 22% in 2019. That is a disappointment. Cash flow of Aegis is a mixed bag. Operational cash flow quite substantial, but in between inconsistent. Working capital changes have been quite volatile in 2019 and 2020. Dividend has remained consistent, and operational surplus in some years has been wafer thin, more particularly 2020. The plus point of the company is that it has invested substantially in fixed assets, suggesting investment in excess of surplus coming from investing and financing activities. Vopak is the privileged partner of Aegis in its joint venture agreement. Vopak is quite big with 69 terminals globally. It is counted as one among the top 3 in global storage. Its oil hub terminals along major shipping routes and LPG terminals in various geographies are quite significant. Overview of the JV between Aegis and Vopak. A company called Aegis Vopak Terminals Limited has been formed, where 49% shareholding will be held by Vopak and Aegis will have 51%. Aegis will contribute its liquid terminals and Kandla and Pipavav LPG terminals, and Vopak will contribute Vopak CRL terminal into the AVTL portfolio. In LPG Haldia, where Itochu is having 25%, Aegis will give 24% to Vopak out of its 75%, and these two verticals of LPG Haldia and AVTL are the basic core of the joint venture agreement. And outside this, whatever business is being carried on, they continue with Aegis, LPG retailing, Mumbai LPG and liquid terminals, Aegis International Marine Services. Aegis will continue exclusively handling it, and as it comes to LPG sourcing, the JV between Aegis and Itochu Japan 60/40 will also continue unaffected. Coming back to the JV, the amount of consideration payable by Vopak for the stake it takes under the JV has been calculated based on the EBITDA for FY22. It is considered at 594 crores and multiple applied is 23, and Vopak is expected to pay around 2,568 crores, which will go into the net worth of Aegis. And there will be a dilution in the interest of shareholders around 20% plus. But the point is 2,568 crores doubling the net worth of Aegis opens up vast opportunities for expansion and growth, and that is the path-breaking wealth creator for the stakeholders of Aegis. And this JV has been announced in July, and it is expected to be implemented over 2022. The vision statement of AVTL is quite clear. Capital expenditure of up to 4,500 crores over next 5 years. Enlarging the throughput and enhancing the capacity utilization in LPG terminals. Expansion of capacity in the existing terminals of LPG and liquid, and going for servicing large ships by compliant jetties, and setting up new LPG terminals in the southern part of the country, and moving into new areas of business in infrastructure and renewable and sustainable energy, and that is a big vision. Various benefits of JV apart, there are concerns on the weak volumes currently prevailing and the project delays on an ongoing basis, and the cheap valuation allegedly used for deciding the consideration from Vopak, and the high capex envisaged under the JV carries the risk of overburdening the Aegis balance sheet with more uncertainty and debt. Besides, getting approvals from the government and working with PSU entities is not considered to be a very strong point when it comes to execution of long-term projects. And over and above this, even the existing LPG units at Kandla and Pipavav are suffering delays in commissioning. And the topmost part of the concerns is the sad demise of the former managing director, who was the key person and the architect in forming the JV, and his absence might be felt in keeping the JV timelines as envisaged. Along with the external concerns are the concerns on the operations in terms of stagnating and falling revenues for over last 5 quarters, and falling EBITDA, which is almost at 500 crores level. Although there have been improvement in the PAT percentage, and we also find an improvement in the EBITDA percentage in the recent quarters. Unless they are supported by a higher volume of revenue, the indices alone cannot come to the rescue of company in terms of volume of profits. Yet another concern in respect of the company is the limited upside available in the share price of the company because of the historically lower profits as well as the higher PE, the current PE being around 27 as compared to sectoral index PE of 25. Even the enterprise value on book value is closer to 4 times, and this hurts any immediate appreciation unless there is clear visibility on the revenue and profitability in the forthcoming quarters. The company's share price movement from April 2020 till date clearly depicts the reflection of the concerns in the market. And the way the share price fell after reaching 359 incessantly over months, bringing it down to the level of prices in August 2020 is a sad commentary on the market's concerns on the company's ability to generate adequate profits to justify a higher price. And that is the reason over a period of 18 months, the company could generate a return of just 34% over 170 rupees. Hopefully, with better visibility on revenue and profits, things might look better. Price movement in the last week of November was quite interesting as the price moved very heavily up with heavy volumes, and the continuation of candles even helped the price to move beyond 23.6% Fibonacci retracement. And the concern was it commencement of an uptrend? A clear understanding of the trend is possible with a look at the 3 months data on price action. The price was moving down till 25th, and with the normal movement in the order size and delivery quantity. But what happened on 25th was the volume moved to 116 lakhs from the normal 6 lakhs. The price also moved up, and the size of the order was quite big at 106 as against normal 40 to 50, and delivery percentage was not matching and it was just 31%. And it was quite clear the entire movement was supported by speculative orders placed by large players, and it was an attempt to take the price up, which only time will tell is it sustainable. From a general perspective, the candles are very positive and very bullish, and there is a crossover of prices over the EMAs of 20, 50 and 100 within a short span of time, and even the placement of candles within the Bollinger Band suggests upward movement, and that way the crossover looks quite decisive. Formation for over last 1 year suggests completion of a triangle for over 12 months ending with November, and commencement of a new triangle with the fresh up move. Although the share price has crossed the 23.6% Fibonacci level of 238, the real trend is possible to confirm only when the price decisively moves beyond the 38.2% Fibonacci level of 267. Bullishness in the trend is visible in the MACD crossing above its signal line. On-balance volume moving in the direction of price is an indication on continuation of the current trend. Aegis Logistics, a reputed player in the logistics industry, has got strong presence in Indian ports. The joint venture is going to be a path-breaking agreement. It is likely to create value for every stakeholder, but the concern is the stagnation of revenue and EBITDA. But the technical indicators are all suggesting bullishness, and there are also concerns on the valuation used in the JV and also persisting delays on ongoing projects. Despite this, the company has got market edge and a futuristic approach to management and a strong overseas shareholding. Hope you liked the presentation. You can access similar informative and content-oriented videos at InfoCard on Stock Learning Simplified. We look forward to your shares, likes and comments. And if you are visiting the channel for the first time, may please subscribe to the channel and press the bell icon for timely intimation on our forthcoming videos. Thank you so much for your time, support and interest. Disclaimer: this video is for the purpose of information, education and awareness only, not meant to be a solicitation or recommendation to buy, sell or hold securities. Wherever applicable, please seek advice of a competent professional.